Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Coming to you from Palm Springs and the greater Coachella Valley area. And of course, it's getting a little busy around this valley right now. And guess why? Because an event you may have heard of before, Coachella Fest. This weekend is the first weekend of Coachella Fest. So we're starting to see a lot more folks around and a little more traffic on the local streets and highways and so forth. So that's always as you know, a very big event here. That goes over 2 weekends, and then of course we finish up April with Stagecoach, and those are basically the last big events of the year here in the Coachella Valley before we go into the off season as we start heading into summertime. So that's exciting, and of course I want to give a shout out and congrats to Michigan, who ended up winning the college basketball championship, beating Duke, or I'm sorry, not Duke, beating UConn. UConn beat Duke to get to the final, but Michigan pretty much had that game from the outset. So congrats again to Michigan. Of course, I had Arizona in my bracket to take it all, and obviously, as you know, that didn't happen. My Angels are sort of wallowing in the right around 500 again. I think they're 6-7 right now after a pretty hot start. Our big star, Mike Trout, after having a great first 2 or 3 games, seems to be kind of going already through another batting slump. He's batting under 200 after a really hot start that first opening couple of days of the season. And of course, the other big news this weekend in the sports world is the Masters golf tournament. I'm not a golfer. I play maybe 4 or 5 times a year, but it's always a fun event to watch. I do enjoy watching it. Of course, I'm entered into a pool with a bunch of guys to see if I can make the right picks. And of course, the big story will Rory repeat? And I checked the leaderboard, and of course, they're still finishing up the first round, but Rory's at the top of the leaderboard at 5 under. He's finished his round for the day. So all the best to Rory. It'd be a great story if he's able to repeat after for so many years of trying to win that event and finally doing so last year. So with that, let's go ahead and get into what's going on in the mortgage and bond market. We're going to start by showing you our rate grid. A little bit of improvement, a little bit of good news. You know, we were just a couple of weeks ago with all this turmoil in the Middle East and the Iran war and oil prices skyrocketing. You know, the bond yields were getting up there at one point, getting close to 450, but and mortgage rates had gotten into the 6.25 range for conventional conforming loans with no points. You can see from the rate grid now we've had a little bit of improvement. We're now down to back to 6 with no points for a good down payment and good credit score. FHA VA back at the 5.5 level. The 15-year loan is at the 5.5 level, and even the jumbos 30-year fix at 6, and then the 7-year ARM at 5 7/8. So the rates are settling down. Got a little nervous there. In fact, just a couple of weeks ago, there was talk about, are we heading back to a 7% conforming 30-year fixed mortgage rate? Well, that looks like that trend toward that number has subsided, and we're again seeing a little bit of improvement. So that is pretty good news. Jeff's going to pull up the chart of the 10-year bond yield. We show that to you every week to show you a 5-day chart. And there you can see you see the Wednesday dip that Jeff likes to see. He's always predicted that Wednesdays are the best day to see a dip in bond yields, and this week that's true. And that's good to see after, you can go back to last Friday when that bond yield, and even earlier this week, was getting pretty far up there. So this has been part of the reason we're seeing some improvement in rates over where they seem to be heading just a couple of weeks ago. A little bit of an uptick at the end of the day today, but again, the fact that we're under 430, I think, is a pretty good sign. And if this ceasefire holds, and of course, if oil prices can settle down, then I think that could bode well for things to improve or settle down even further, so that we can get rates for both conforming, conventional, as well as FHA, of course, FHA and VA already being in the 5s. We want to see those conventional rates get back into the 5s as well. Just again, we were at that point, a little over a month ago when we were offering 5 5/8 and no points. So we want to get back into those 5s because I think that'll be a big shot in the arm for the mortgage market. So what is going on this week in terms of economic data that might be part of the underpinnings of where we're at with bond yields? Well, this week the calendar is kind of light, but the big data points this week are inflation numbers. Two big inflation numbers this week: the PCE and the CPI. So let me start with the PCE. Again, that's Personal Consumption Expenditures Index. This is the index favored by the Fed. The Fed believes this is the index that gives the best insight as to what's going on with inflation. And it's an interesting number because this actually came out today. And, the headline that I was seeing about this release seemed to be a little inconsistent with the actual numbers. Because what I had seen in a headline here this morning, when I was checking for this release, I saw a headline that said this exhibited an uncomfortable increase. Well, I'm kind of shaking my head about that because, as you can see there on our sheet here, the February core PCE, the monthly number was 0.4%. That's actually unchanged from the month before. And the annual number is 3.0%, which is actually one tick, 0.1% below what it was the previous month. So how that headline could suggest we've seen an uncomfortable increase with this release today doesn't quite jive with the actual numbers that were released. And a reminder, core PCE means excluding food and energy. Those are considered volatile data points in terms of establishing or evaluating where inflation is. So really kind of strange not strange in the sense we see this too often, where the headline sometimes isn't really connected with the actual numbers that have been released. And I think that's the case here. Now, tomorrow is the other big inflation number, the CPI. That's the Consumer Price Index. And this is interesting because for March, 0.9% is forecast for the monthly number and 3.3% forecast for the annual number. And again, this is interesting because those are pretty big numbers in terms of an increase that are being forecast. Now, when you go to the March core CPI, again, excluding food and energy, the forecasts are 0.3% monthly and 2.7% annual. So those are up a little bit from the previous month as to what's being forecast, but not up nearly as much as the CPI, including food and energy. And so you would say, well, why is the CPI, the forecasted increase is so high compared to the core CPI that excludes food and energy? Well, as I'm going to show here on the next bullet point, I think oil prices obviously have something to do with this sort of divergence of the CPI and the core CPI. Obviously, when you include food and energy, in particular energy, and the very rapid increase and substantial increase in oil prices and therefore gas prices pretty much during the entire month of March, that, of course, would be no surprise why the CPI number, which includes oil, energy, would have a forecasted increase of that magnitude that you see. But again, when you peel that out, then the inflation numbers don't look so bad. So that kind of underscores the argument that if this CPI number, including food and energy, does come in hot, as they like to say, I would argue that would be perceived as still hopefully a relatively temporary situation, and that the markets won't react too negatively if those numbers that are forecast do bear out. And of course, they'll look further in more detail at the core CPI, and if that core CPI is more muted as forecast, the 0.3% monthly, 2.7% annual, then that would again underscore even more that the CPI number may be abnormally high and hopefully temporary, simply because of what's going on in the Middle East and with oil prices and the Iran war. So we'll see how that comes out tomorrow. Again, I would suspect that if the core piece CPI ends up being as forecast or maybe slightly better, we shouldn't have too much of an adverse reaction in the bond market. So that would certainly support the idea that mortgage rates should stay kind of stable and maybe even get a little bit better if those CPI numbers come in better than expected. So again, that's what's going to happen tomorrow morning. So for those of you who I've court of encouraged to look at the 10-year bond yield, take a look at that when the market opens in the morning, and you'll be able to see for yourself what the impact's going to be once these numbers are released. So with that, I'm going to go into our next segment. I want to spotlight a product that actually, it's interesting because it's been around for years, and yet I can tell that there may be a new investor in the mortgage business, in the mortgage industry. Several of our lenders are now starting to tout this program. So I want to go over the particulars on it. And as Jeff just pulled up the slide, we call it the doctor loan. So what the heck is a doctor loan? Well, of course, it's a program that is designed specifically for borrowers who are doctors. And in particular, I think the focus here is for borrowers who are essentially just becoming a doctor. In other words, they've gone to medical school, they've graduated, they've gone through their internship, and they're now at a point where they're going to be, entering the medical field as a fully credentialed doctor and starting their practice. And that can be challenging from a lending perspective because the new doctors at this stage in their career are just getting going. And so there may be a lack of a history in terms of employment and income stability to be able to establish that the person qualifies in respect to the ability to repay. So the first thing to note is it is built for medical professionals, and it includes the certain types of medical designations, doctor designations, as you can see there, MD, DO, DDS, and so forth. Now, keep in mind this program is only for loans made on a primary residence. So a doctor who's just starting their practice, who wants to buy a vacation home, maybe here in the desert or, on the coast and what have you, this program does not apply. It's only for financing a primary residence. The nice thing about the program is you can get loan amounts up to $2 million, which of course, most doctors, when they start their practice, they're generally going to get compensated pretty handsomely. And so in many cases, getting a loan amount up to this $2 million level is important as to availability, because chances are the kind of properties they may be looking to buy may require financing at these levels. The program offers both fixed rate and hybrid ARMs. So the fixed rate includes the typical options, 15, 20, 30-year loans. Hybrid ARMs, those are the ARMs that we've talked about before on the show that are basically, they're considered a hybrid because they provide characteristics of both fixed rate loans and adjustable rate loans. The hybrid ARMs typically are 3-year, 5-year, or 7-year ARMs. What that means is the initial rate and payment are fixed for 3, 5, or 7 years. Then after that, after the fixed period, the loan adjusts once per year for the remaining term out to 30 years. So a 3-1 ARM, rate and payments fixed for 3 years, and then you'll adjust once a year for the remaining 27 years. 7-1 ARM, of course, fixed for 7 years, and then again adjusting every 1 year for the remaining 23 years. And there are caps on both the adjustment as well as the life cap. Minimum credit score is pretty lenient, 680 for this type of loan, and you can get up to 100% loan to value. Now, if you're at a 680 credit score, that'll get you 100% loan to value up to a $1.5 million loan amount. If you want to get 100% financing up to a $2 million loan amount, you do have to have a credit score of at least 720. Now, the other interesting thing is that, particularly if you're going to go with zero down payment, or let's say it's going to be not zero, but 5 or 10% down, this program does not have mortgage insurance. So that's a good thing. Mortgage insurance is an additional cost added to the financing. It's typically required on a conventional loan where your down payment is less than 20%. Again, mortgage insurance insures the lender against default by the borrower. So with this program, nice to be able to say there is no mortgage insurance coverage on the loan, and therefore no mortgage insurance cost. Now, as a consequence, the rate on these is going to be a little bit higher than that jumbo 30-year fix you saw on our rate grid at 6%. And part of the reason for that is taking into account the fact that there's no mortgage insurance when we have minimal or no down payment. Now, the most important aspect of this product has to do with, in addition to the loan parameters I just reviewed, has to do with the underwriting advantages for medical borrowers. And the advantages include a couple of things. You can get approved if you can provide a fully executed employment contract or offer letter. The loan can actually get approved by presenting this sort of document as long as it stipulates some details, like what your job title is, what your start date is, what your compensation is, and it's going to be looking for compensation that's going to be fixed in nature, a salary essentially. If it's a compensation that is more variable, although when you come to a doctor, it's not like you see a lot in the way of, certainly not commissions, even bonuses generally are not that common with doctor compensation. But the point is, this employment contract, that's, if it's been executed, it's got to be specific about what your job title is, what your compensation is going to be, what your fixed compensation is going to be, what your start date is. Now, what's interesting is the start date is allowed to be up to 150 days after the note date. Now, let me translate that for you. What does it after the note date means? Well, it means at the time you're drawing docs, the closing docs, part of the documents is going to include a note. The note stipulates the actual loan terms, the loan amount, the interest rate, what the monthly payment is, when is the first, what is the date of the first monthly payment that's due. So the idea here is you can, if you've got a fully executed employment contract, you can actually get approved with that. You haven't actually been paid yet. We can actually get you all the way to clear to close, have the closing docs drawn and sent to the escrow office where you'll sign them for funding. And you still, at that point, don't have to provide evidence you've started receiving your compensation. That is okay as long as your compensation starts within 150 days after the note date. So what that is basically saying is, just with an executed contract, you can sign your closing docs and close as long as the first date of your compensation occurs within 5 months after you close. That's pretty remarkable, especially for the loan business, where in general, I like to say, mortgage underwriting, it's all about, underwriters are historians. They're not futurists. They generally don't accept using anything in the future as to income to qualify you and close your loan now. Well, the doctor loan is an exception to that. So again, with this, if you've got this kind of medical credentials and you have a fully executed agreement, yes, you can close that loan as long as you're going to start getting paid within 5 months of closing. And then the last important thing to know is student loans. Payments on your student loans can be excluded from your DTI. When you as the medical professional, you're in residency or fellowship and you're able to qualify on your current income. So that's a pretty huge thing too, because as you may suspect, and of course I've seen this quite often, folks coming out of medical school and starting their medical career, their doctor career, oftentimes will do so with a substantial amount of student loans that, in a lot of cases can be an obstacle in terms of getting approved for the loan, because even if those student loans are deferred, we still have to make a calculation as to what the assumed payments are. So for a medical professional that's in this situation, in residency or fellowship, and if their income they're getting paid is sufficient to otherwise qualify for the loan, we can ignore those payments on the student loans. And that can be very, very helpful in getting a doctor who is starting their career, get qualified and get approved to purchase and own their first home. So this is a pretty terrific program. So if you or anyone you know in your family, other in your sphere of influence, if you know of any folks who are in the early stages of beginning their medical career, and where these kinds of parameters will help them in terms of getting financing to purchase their first home, give me a call. I'll be happy to go over some numbers with them, get them pre-qualified, show them some worksheets as to what this kind of loan will provide them as to terms, and again, hopefully get them on their way to home ownership as they start their career in the medical profession. So with that, we're going to go ahead, and Jeff's going to come on, and we're going to have a little bit of discussion about a few different topics that I think are pretty relevant right now as to the mortgage industry and where the market is going in terms of affordability and opportunities to get into home ownership. Hey, Jeff.
Hi, Art. Hey, I just have a question about your things that are moving the market. I was reading this morning about a couple of things that are, like you said, hey, is it oil? And as I was drinking my morning coffee, it said coffee is one of those indicators that we've seen the costs go up significantly, like 50%, and the other is beef. And so how much does that play into the inflation? Because they were also pointing out that not everything is going up. Like eggs have gone down by 50%. It used to be one of those things was like you had to take out a mortgage with you to get a dozen eggs. Now you can get a dozen eggs for $3. So,
well, that's true. It's funny you say that because last weekend I bought 36 eggs, 2 packages, 18 each. And I think each package of 18 eggs was like $4.39.
Yeah.
So you could buy, what is that? 3 dozens of eggs for less than $9. And consider what, all the hand wringing about the price of eggs here a year or so ago. It's just kind of funny how that's no longer the news because the prices have come down a whole lot. But at the same time, what you're pointing out kind of underscores why when you get into both the PCE and the CPI and even the PPI, that's why the data is released in basically kind of two formats. The I guess I'd call it the full CPI, for example, which includes food and energy. So of course that can be a mixed bag. Right now, in terms of the food side of that, you've got different things going on. Egg prices have plummeted. Coffee prices and beef are up. So ultimately what squirts out is, how many type food items are dropping versus how many are going up. And then of course you've got to get into what amount of those different food products are part of, everybody's daily or weekly or monthly, grocery shopping and consumption and so forth. And so that's why with these data points, again, all the inflation numbers usually have the full number and then the core excluding food and energy, because the idea is the food and energy segments can be very volatile and they can jump around quite a bit for short periods of time based on external factors that may not establish a longer term trend. And so that's why a lot of times the Fed and most economists want to look at that core number that excludes the food and energy, because I think really that becomes a little bit better and a more stable indication of where inflation is going in the future.
Well, I have to echo something you've said many, many times, especially when you were talking about the uncomfortable rise in the inflation number, and yet it was right on target or better than before. And beware the headlines.
Well, yeah, I mean, again, I've said on the show before, I always start off early in the morning looking at the markets because I want to see what's going on with, not just the stock market, of course, but, particularly the bond market. And I knew, of course, we had the inflation numbers being released this week. And so when I checked very early this morning and I saw that the inflation number looked pretty tame, and yet on the business page I was looking at, and I think it was CNBC, I see this headline about an uncomfortable increase. I'm like, well, wait a minute. What is going on here? Why did this person write that when the data doesn't support, the numbers don't support that kind of a headline? Now, I don't know what a person like that, what their motivation is to somehow take what otherwise looks to be relatively tame and maybe I wouldn't call it a cool number, because the favorite terms now are cool or hot. If the inflation number comes in below expectations, it's cool. And if it comes in above expectations, even by a tick, it's hot, and it's like, and that's part of my problem with the headlines too, is they use some descriptive terms that I think exaggerate what's really going on. Like when you see something about rates have plummeted. Well, okay, we've gone from 6.1 to 6.
Yeah.
Or mortgage applications have, skyrocketed. Well, they're up, 10% over what they were a year ago. Well, of course, even a year ago, mortgage applications were, only 50% of what they were before the pandemic, for example. So it's like, it's all relative, and you got to peel through those headlines and understand that a lot of those headlines are, they're clickbait. They're trying to, send a message and get your attention. And sometimes I think in doing so, they're done otherwise.
Yeah, that's so true. Well, talking about hot, I want to talk to you and really kind of dive in a little bit about the fact that we're looking at, for home buyers, could this be the best housing market we've seen for first-time home buyers in a while?
Well, I think so. And of course, despite what I just said, I mean, I did pick up on a couple of news stories that were suggesting that. And I thought, well, that's curious, because this seems to go against the flow of most of the headlines that continue the doom and gloom about what's going on with mortgage rates and the housing markets. And so when I kind of dive deeper into what's going on here, one of the things that was interesting was there's an index. First American has an index called the Real House Price Index.
Mm.
And what it showed is that affordability in all 50 states has improved as of the end of 2025.
Wow.
That's pretty noteworthy. I mean, all 50 states, affordability has increased at the end of last year. And so you go, okay, well, that's pretty good news. So why all the doom and gloom? And in fact, this improvement in affordability is the best as it's been in 3 years.
Wow.
Well, that makes some sense, because I've been saying here for a few months now, just go back 2.5 years ago, we were getting dangerously close to having to talk about an 8% mortgage rate.
Mm.
When the 10-year bond yield was getting close to 5. And so it would make sense then that in that time since then, with mortgage rates, even with the increase we've had during this Iran situation, have gone up a bit, we're still a good 2% or more lower than they were 2.5 years ago. So it would make sense then that affordability has improved to this extent in the last 3 years. And so to me, that's a great indicator of the fact that people are in a position, or should be in a position, to afford a home much more than they think they can. The key is getting them to understand and believe that that's even true. Because I think right now, too many folks are sitting on the sidelines dwelling on all the negative headlines and just made a decision, an assumption, oh, it's out of reach, and so I shouldn't even try. And I think that's unfortunate.
Yeah, and one of the things that seems to be jumping out at me is, and I have to ask this as a question, is, are we finally seeing a shift where buyers have some control that they haven't seen in a while?
Well, I think so, because, economic term. Well, the most recent real wage release was real wages wages are up 3.5%. Well, if the inflation rate is 2.5%, but wages are up 3.5%, that means you've had an increase in real wages. Wages have increased beyond the rate of inflation, which, what does that mean? It's improving purchasing power.
Mm.
If your incomes are rising faster than inflation, that's a good thing. And that is getting you in a position to be able to more affordably purchase a home, because your wages have increased at a better rate than the inflation rate. So that's one thing to keep in mind. Home prices have stabilized. Now, they haven't dropped in a significant way, but the rate of increase has slowed. We've been talking about that for months. Last week, we mentioned the